Have you ever found yourself, looking at something you want to buy or sell down the line? Maybe a car, a house, or I don't know, even something simpler, and you just wish you could lock in today's price right now for that future deal. You want that certainty, right? A guarantee against whatever might happen with prices later. Well, what if I told you there are actually powerful financial tools designed for exactly that? Welcome to the deep dive. Today, we're diving into the, well, fascinating world of forward and futures contracts. Our mission here is pretty straightforward. We want to pull out the key insights from our source material, break down what can feel like really dense financial stuff, and turn it into clear, actionable understanding for you. We'll explore what these things are, who uses them, and importantly, why they matter so much for managing risk and making smart moves in the market. Okay, let's get into it. So at their core, both forward and futures contracts seem to be about making a deal today for something that happens, well, later. But how do they actually work?
That's the perfect place to start. Because the story really kicks off with forward contracts. Think of it like a direct private agreement, a handshake almost, between two people or businesses. They agree right now to buy or sell something, an asset, at a price they decide today, but for a specific date in the future. All the terms, locked in from the start.
So it's really just a promise for a future transaction. Can you maybe give us a more concrete example, something relatable, like, say, gold?
Absolutely. Let's use an example from our source material. Imagine it's May 11th, 2024. If you wanted to buy gold right then in the cash market, you'd pay the current price, the spot price, let's call it 62,130 rupees for 10 grams. You pay, you get the gold. Simple.
Right, but what if I need that gold, say, a month from now, but I'm worried the price might shoot up by then?
That's exactly the scenario for a forward contract. A goldsmith might anticipate this and quote you a forward price, maybe ours, 62,337 for those 10 grams, but delivered in 1 month. Now, if you agree to that, you've essentially bought a forward contract. We call that taking a long forward position. The goldsmith selling it to you has sold a forward contract or is short forward. And the crucial thing here, no money changes hands yet, no gold moves. It's purely an obligation. Both sides have to follow through in a month, regardless of where the market price for gold actually ends up.
That obligation part sounds really key. So besides that, what are the defining features? What makes a forward contract a forward contract?
Well, first, they're bilateral. Just between those two parties, nobody else. Every single detail is fixed right at the beginning. The price, how much, the quality, delivery details, how it gets settled, and they're usually over the counter or OTC. That means they're custom-made, privately negotiated deals, not on some public exchange. And, if both sides agree later, they could potentially tweak the terms. The whole point, really, is to nail down the price today to avoid that future price risk.
Certainty.
Okay, certainty. But how does it actually play out? How do you know if locking in that price was a good move or not? Let's stick with that gold example. You locked in ours, 62,337. Now, fast forward 1 month. If the spot price of gold has jumped to ours, 62,700, well, your contract looks pretty good. You get to buy at your agreed lower price of 62,337, and if you wanted to, you could immediately sell it in the market for 62,700. That's a profit of ours 363 right there. But what if the price went the other way? Say it dropped to ours 62,100. You're still stuck buying at your higher contract price of 62,337. So if you sold immediately, you'd face a loss of ours 237. It all depends on where the market moves relative to your fixed price.
Right. Makes sense. Now, this is where I think it gets really interesting, because even though forwards sound useful, they apparently have some pretty big downsides.
Limitations.
These limitations are actually why futures contracts were invented. It's like market evolution in action.
Exactly right. One huge headache is liquidity risk. Because these contracts are custom private deals, they aren't traded anywhere. So what if you need to get out of your gold contract early? Finding someone else who wants exactly your specific tailor-made agreement, it's incredibly difficult, almost impossible sometimes. You're basically stuck holding it until the end date.
Okay, stuck. That's one problem. What else?
Then there's the big one, counterparty risk. It's also called default risk or credit risk. This is the very real danger that the other person, your counterparter, simply won't or can't fulfill their side of the bargain when the time comes.
Oh, like they might just walk away.
Precisely. Imagine a farmer agrees today to sell you rice in 6 months at 40 rupees per kilo. But when delivery day arrives, the market price is shot up to 50 rupees. That farmer might be really tempted to just ditch your private deal and sell on the open market for more money. Or, flip side, if the price crashes to 35 rupees, you might be tempted to back out and buy cheaper rice elsewhere. This temptation to default when the price moves against you is a fundamental weakness of forwards. And on top of that, there's generally less transparency, and settling these private deals can get complicated.
Okay, so we've got these customized deals, but they're hard to get out of, and there's a real risk that the other side flakes. That sounds like, yeah, a problem waiting for a solution.
And that solution was the creation of futures contracts. They were engineered specifically to fix those problems with forwards. How? By bringing them onto a centralized, regulated trading platform in exchange. So fundamentally, a future is a type of forward contract, but it's standardized and traded on an exchange. And here's the absolute game changer. There's a clearing corporation involved.
A clearing corporation, what do they do?
They step into the middle of every single trade. They become the buyer to every seller and the seller to every buyer. What that means is they guarantee the settlement of every contract. They completely absorb that counterparty risk. It's massive.
Well, okay, so a third party guarantees the deal. That totally changes the risk picture. So what are the key features of these improved futures contracts then?
Well, they trade on an exchange, so you get a central place for everyone to see prices. That's price discovery. Crucially, both the buyer and the seller have to put up margins. Think of it like a good faith deposit. This drastically cuts down the incentive and ability to default. And unlike forwards, the contracts are standardized. The quality of the gold, the amount, it's all predefined by the exchange. So a Nifty Index future is the same contract no matter who you trade it with. Standardization is key.
Fewer risks, standardized terms, more transparency. Sounds like a definite upgrade.
Yeah.
But are there any downsides, any limitations to futures compared to forwards?
Oh, sure, there are always trade-offs. Because they're standardized, you lose flexibility. You can't tailor a futures contract to your exact needs like you can with a forward. Maturities are limited to what the exchange offers. You can't just pick any date. They're also only available for certain underlying assets, not everything. And while they solve counterparty risk, the whole margin system and daily settlement process, which we'll get into, adds some administrative complexity and cost. But what's really fascinating, I think, is seeing how the market itself innovated. It identified the problems with forwards, the risk, the illiquidity, and engineered a solution. Standardization, exchange trading, the clearinghouse guarantee. It transformed a niche, risky agreement into something broadly accessible, much safer, and critically trustworthy.
Trustworthy, yeah, that feels like the core improvement.
Ow,
Okay, let's
no.
dig into the nuts and bolts then. The anatomy of a futures contract. I hear terms like contract size, tick size. What are the actual pieces?
Right, so the exchange sets almost everything except the price, which the market determines. First, you have the underlying instrument. That's simply what the contract is based on. Could be the Nifty 50 index, a specific stock, a commodity like oil, whatever. The price of that underlying in the regular cash market is the spot price. So for Nifty, maybe that's 202.50 right now.
And you don't trade just one unit of Nifty, right? They come in batches or lots.
Exactly. That's the contract multiplier, or contract size. For Nifty futures, the current size is 25. So if the Nifty futures price is, say, 200, 400, and 875.70, the total value of one single contract is actually 25 times that number, which is, let me see, RS, 6,036,893. Quite substantial.
And I think I heard something about SEBI, the regulator in India, changing the required size of these contracts recently.
You did. That's a significant development. Starting November 2024, SEBI mandated that new derivative contracts should have a value somewhere between 15 and 20 lakh rupees when they're introduced. That's a big jump from the previous 5 to 10 lakh range. So, yes, that generally means lot sizes have had to increase for many contracts to meet this new higher value threshold. The idea is to encourage participation from more serious traders and potentially deepen market liquidity.
Interesting. What about the lifespan of these contracts? How long do they last?
That's the contract cycle. On the NSE in India, for indices and stocks, you typically have 3 months available to trade at any given time. The near month, the next month, and the far month. So for instance, you might see October, November, and December 2024 contracts trading simultaneously. BSE, the other major exchange, also offers monthly contracts and even weekly ones for some indices, giving traders more timing options.
And they don't just go on forever. There's a specific end date.
Correct. That's the expiration day. It's the very last day you can trade that specific contract. After that, it ceases to exist, and any open positions are automatically settled. If you want to maintain your market exposure, you have to actively roll over your position, basically close the expiring contract, and open a new one in the next contract month. For Nifty and Bank Nifty futures, expiration is usually the last Thursday of the month, though sometimes it's the last Wednesday for Bank Nifty options.
Okay. And the smallest possible price change, that little increment.
That's the tick size. For Nifty futures, it's incredibly small, just 5 paisa, or 0.05 rupees.
Now, you mentioned margins and daily settlement. This sounds like a really critical difference from forwards. Can you unpack marking to market, or MTM?
Yes, MTM is fundamental to how futures work and manage risk. Every single day, the exchange looks at all the open futures positions. It calculates an official daily settlement price, usually based on the weighted average price during the last 30 minutes of trading. Let's say you bought one Nifty futures contract earlier at 2022.50, and at the end of the day, the settlement price is 22308.70. Your position has gained 58.70 points. Since the Nifty lot size is 25, your MTM gain is 58.70 times 25, which equals Rs 1,468. That amount is literally credited to your trading account that same day. If the price had gone down, the loss would be debited from your account daily. This daily cash settlement prevents large, unmanageable losses from building up over time. It ensures everyone can meet their obligations day by day.
Wow, okay. Daily cash flow based on price moves. And the very last price on expiration day.
That's the final settlement price, and it's simply the closing price of the underlying asset in the cash market on that final expiration day. So for an October Nifty futures contract, the final settlement price would be the official closing value of the Nifty 50 index itself on the last Thursday of October.
Trading hours are just the standard market hours, I assume.
Yep, 9:15 a.m. to 3:30 p.m. Monday through Friday, just like the stock market.
Are the futures for the BSE Sensex index pretty much the same as Nifty, or are there key differences?
They're similar in concept but have some different specs. Sensex futures have a smaller contract size, currently 10. They also offer more granularity with 7 weekly contracts alongside 3 monthly ones. And importantly, they expire on Fridays, not Thursdays. Because Sensex and Nifty are highly correlated, they tend to move together. This difference in expiry days and contract specs sometimes allows traders to do pairs trading or spread strategies between the two indices.
Okay, that covers the structure. But like any specialized area, futures trading has its own language, right? Let's decode some key terms. What about basis? What does that mean here?
Basis is pretty simple conceptually. It's just the difference between the current spot price of the underlying asset and its futures price. So if Nifty spot is 2,500, and the near month Nifty future is trading at 25475.70, the basis is spot minus futures, which is negative 225.60. It's negative in this case. The really crucial thing about basis is that it must converge to zero as the futures contract approaches its expiration date. On the final day, the futures price and the spot price become identical. Has to happen.
Got it. And cost to carry. Sound like, well, what cost to carry something.
That's exactly the intuition. It bundles up all the costs associated with holding the actual underlying asset until the future delivery date. Think financing costs like interest if you borrowed money to buy the asset, storage costs if it's a physical commodity, insurance, and then you subtract any income the asset might generate while you hold it, like dividends from a stock or interest from a bond. So for stocks, it's mainly the interest cost minus the dividend yield. Let's say you buy a share for Rs 100 today. You borrow money at 6% interest for a year, but you expect to receive a RS2 dividend during that year. Your net cost of carry is RS6 minus RS2, which is RS4. This implies that the fair price for a 1-year futures contract on that stock should be around RS104, 100 plus 4. It reflects the total cost of buying now and holding versus buying later via the future.
Okay, and you stressed margins earlier. Let's dive deeper into the margin account. How does that work day to day?
Right, margins are the bedrock of risk management in futures. Since a clearinghouse guarantees the trade, it needs collateral from both parties. The initial margin is the deposit you have to put up just to open a futures position, long or short. So if a Nifty contract is worth, say, Rs 5,056,250, and the exchange requires a 10% initial margin, you'd need to deposit Rs 55,625 to trade one contract. Both the buyer and the seller have to post this margin. Then, as we discussed, marking to market MTM happens daily. Profits are added to your margin account, and losses are deducted. If your account balance drops below a certain level, called the maintenance margin, you'll get a margin call from your broker demanding you deposit more funds to bring it back up to the initial margin level. It's a continuous process to ensure solvency.
Okay, clear. Now, two terms that sound similar but are different. Open interest and volumes traded. What's the distinction?
Yeah, they often confuse people. Think of open interest OI as a snapshot. It's the total number of contracts for a particular feature that are currently outstanding, meaning they haven't been closed out or settled yet. It tells you how many active bets or positions exist in the market for that contract. Since every long position has a corresponding short position, OI is counted only on one side. High OI suggests deep liquidity and strong interest. Volumes traded, on the other hand, measures activity over a period, like a day. It counts the total number of contracts that have changed hands, bought, and sold. Let me try an example. If A buys one contract from B, who sells short, OI goes up by 1 and volume is 1. If C then buys one contract from D, who sells short, OI goes up to 2 and total volume is now 2. But now suppose A decides to close their position by selling their contract to C, who is buying to close their short position. Let's say B sold to C earlier. What happens? Volume increases by 1 because a trade occurred, but open interest decreases by 1 because one long and one short position were simultaneously closed out. See the difference? Volume is flow, OI is stock.
Ah, okay, that clarifies it. Volume is the churn, OI is the number of live positions. Got it. And price band, is that like a circuit breaker?
Exactly. It's the maximum range a futures contract price is allowed to move up or down in a single trading day, usually set as a percentage of the previous day's closing price. If the price hits the upper or lower band, trading might be temporarily halted. It's designed to curb extreme volatility and panic selling or buying.
Okay, last set of terms here regarding positions. What's a long position, a short position, and just an open position?
Simple enough. A long position means you've bought futures contracts and haven't closed the position yet. You generally profit if the price goes up. A short position means you've sold futures contracts without necessarily owning the underlying first and haven't closed the position. You generally profit if the price goes down. An open position is just any futures position, long or short, that you currently hold and hasn't been offset or expired yet. You might have multiple open positions across different contracts or months.
And what about naked positions versus calendar spread positions?
A naked position is simply being long or short futures without having an offsetting position in the underlying asset itself. You're fully exposed to the price movement of the futures contract. Most speculators take naked positions. A calendar spread position is a bit more complex. It involves simultaneously holding a long position in one futures contract month and a short position in a different month, but on the same underlying asset. For example, being long December Nifty futures and short October Nifty futures. Traders use spreads to bet on the change in the difference between the two contract prices rather than the outright direction of the market. It's often considered a lower risk strategy than a naked position. And of course, once the near-month contract expires, you're just left holding the far-month contract, which then becomes a simple, open, potentially naked position.
And just to be crystal clear, opening a position and closing a position.
Opening is the initial trade that establishes your long or short stance, buying to go long or selling to go short. Closing is the subsequent opposite trade that gets you out of that position. If you were long, you sell to close. If you were short, you buy to close, also called covering your short.
Okay, wow. So pulling it all together, it means futures trading isn't just some simple bet. It has this whole rich vocabulary, very specific rules, very specific mechanics. But every piece, from the tick size to MTM to margins, seems designed to build that trust, make the market work smoothly, transparently, and manage risk far better than those old-style forward contracts. Now, let's try and visualize this. How do these positions actually translate into profit or loss? You mentioned payoff charts earlier as a way to see this clearly.
Yes, payoff charts are really useful. They give you a simple visual snapshot of your potential profit or loss at the moment the contract expires, depending on where the underlying asset's price ends up. Typically, you plot the underlying price on the horizontal axis, x-axis, and your profit or loss on the vertical axis, y-axis. For futures, the payoff is linear, a straight line.
Okay, so let's take a long futures payoff. If I buy a futures contract at, say, RS100, what does that line look like?
All right. If, at expiry, the underlying asset's price is RS150, your contract lets you effectively buy at RS100. So your profit is the difference, RS50. The line goes up. If the price at expiry is only R70, you still have to honor the RS100 purchase price from your contract. So you've effectively lost R30 compared to the market price. The line goes down. It's a straight upward sloping line starting from the point where the underlying price equals your contract price. RS100, in this case, that's your break even. Below 100, you lose money. Above 100, you make money. And theoretically, there's no limit to how high the price could go, so potential profit is unlimited. Likewise, the price could theoretically fall towards zero, making the potential loss substantial, though capped at the purchase price itself.
Makes sense. So a short futures payoff must just be the mirror image, right? Sloping downwards.
Exactly the opposite. If you sell a futures contract at Rs 100, you want the price to fall. If the expiry price is Rs 60, you can buy the asset in the market at 60 and deliver it against your contract for 100, pocketing a Rs 40 profit. But if the price rises to Rs 150, you're obligated to deliver at 100. You'd have to buy in the market at 150 to fulfill that, resulting in a Rs 50 loss. So the short futures payoff is a straight downward sloping line. You make money as the price falls below your selling price, 100, and lose money as it rises above 100. Again, potential profit is capped, price can't fall below zero, but potential loss is theoretically unlimited as the price could rise indefinitely. And this clear picture of potentially unlimited risk, especially for short sellers or large losses for buyers if the price collapses, really begs the question, why would people do this? What's the motivation? And that brings us squarely to the different types of players in these markets and what they're trying to achieve.
Exactly. Because this market isn't just random gambling. There are distinct groups of participants, right? The source material mentions three main types who make this whole ecosystem work: hedgers, speculators, traders, and arbitrageurs.
That's right. They each have different goals, different risk appetites, but they all interact and, in a way, need each other. Let's start with the hedgers. Hedgers are not primarily trying to make profits from price swings. Their main goal is risk reduction. They want to protect themselves from unfavorable movements in things like interest rates, stock prices, commodity prices, variables that could negatively impact their business or investments. They use futures like an insurance policy.
So this is our farmer locking in a price for his crops, that kind of thing.
Perfect example. The farmer sells futures today to guarantee a price for his harvest later, protecting against a price drop. Or think of a company like an airline. They need jet fuel constantly. They might buy futures contracts on crude oil to lock in their fuel costs, protecting against rising oil prices, or even a large investor holding a big portfolio of stocks. If they fear a market downturn is coming, they might sell index futures, like Nifty futures, as a temporary hedge to offset potential losses in their stock holdings, without having to sell off all their individual shares. It's about managing future uncertainty.
So it seems like there are two main directions for hedging: long and short.
Correct. A long hedge involves buying futures. You do this to protect against a price increase for something you plan to buy later, like the airline buying oil futures, or maybe someone expecting to receive a large sum of money soon and wanting to lock in current stock market levels by buying index futures now. A short hedge involves selling futures. You do this to protect against a price decrease for something you already own or plan to sell later, like the farmer selling crop futures or the investor selling index futures to protect their portfolio's value.
And what's a cross hedge? Does that mean using a slightly different contract?
Exactly. Sometimes there isn't a perfect futures contract available for the exact asset you want to hedge. So you find the next best thing, a futures contract on a closely related asset whose price tends to move in tandem. Like our airline example again. There might not be specific jet fuel futures easily available, so they use crude oil futures, which are highly correlated. Or the investor hedging a diverse stock portfolio with Nifty futures. The portfolio isn't identical to the Nifty index, but it's close enough for the hedge to reduce overall risk. You find the best available proxy.
When hedgers are setting this up, how do they pick which contract month to use? October, December.
The general guideline is to choose a futures contract that expires just after the date your actual exposure ends or your planned transaction occurs. So if you need to hedge a sale planned for June 20th, you'd likely use the June futures contract, which typically expires towards the end of June. You wouldn't use the May contract because it would expire too soon. You want the hedge to cover the entire period of your risk.
Okay, so hedgers are the risk managers. Now, moving on, we have the speculators or traders. These sound like the ones embracing the risk.
That's their game. Speculators are purely focused on profiting from predicting future price movements. They aren't necessarily trying to offset an existing business risk. They take on risk willingly, hoping to be right about the market's direction. And futures are attractive to them because of leverage. Remember how a small margin deposit controls a large contract value? This means even small price movements can result in significant percentage gains on their invested capital.
What?
But it's absolutely a double-edged sword. That same leverage magnifies losses just as easily. Speculators typically take those naked, long or short positions based on their forecasts. And importantly, they play a vital role by providing the liquidity needed in the market. They are often the counterparties taking the other side of the hedger's trades. They might also engage in more complex strategies like spread positions, like those calendar spreads we mentioned, which involve taking simultaneous long and short positions in related contracts. These are often seen as a more conservative form of speculation.
Right. And the third group, the arbitrageurs, you called them the market's efficiency police earlier.
Huh. Yes, that's a good way to think about it. Arbitrageurs look for tiny, temporary discrepancies in prices situations where the same asset is effectively trading at different prices in different markets or forms simultaneously. Their goal is to lock in a risk-free profit by exploiting these mispricings. They act like the market's plumbing, ensuring prices stay aligned between, say, the cash market and the futures market, or between different exchanges. By buying low in one place and selling high in another simultaneously, they push prices back into equilibrium, making the overall market more efficient.
Can you walk through a simple arbitrage example again?
Sure. The classic is cash and carry arbitrage. Imagine stock AVC is trading at Rs 100 in the cash market right now, and the futures contract for AVC expiring in 1 month is trading at Rs 102. An arbitrager could simultaneously buy the stock in the cash market for Rs 100 and sell the futures contract at Rs 102. They then hold the stock for the month. At expiry, the futures price and spot price will converge. They deliver the stock they bought against the futures contract they sold, fulfilling their obligation. Regardless of whether the stock price ended up at 90 or 110, they bought at 100 and effectively sold at 102, locking in our Rs2 profit per share, minus any small transaction costs or carrying costs. The opposite, trade buying futures and selling the cash asset if the future is too cheap, is reverse cash and carry arbitrage. There's also inter-exchange arbitrage, just exploiting tiny price differences for the exact same stock or future listed on two different exchanges, like buying on BSE and selling on NSE if there's a momentary gap.
It sounds almost too good to be true risk-free profit. Are there really no catches for arbitrageurs?
Well, risk-free is the theoretical ideal. In practice, there are hurdles. Execution risk is one. There might be a tiny delay between placing the buy order and the sell order, during which prices could move against you. One leg of the trade might not fill immediately if the market is illiquid. Transaction costs, taxes, and margin requirements eat into the potential profit, meaning the price discrepancy needs to be large enough to overcome these frictions. And if physical delivery is involved, more common in commodities, there can be logistical complexities and costs. So while the aim is risk-free, execution isn't always perfectly seamless.
This is actually really fascinating when you step back. You have these three groups. The hedgers playing defense, trying to eliminate risk. The speculators on offense, taking calculated risks for profit. And the arbitrageurs acting like referees, keeping prices consistent. They all interact, and this interaction is what makes the futures market function, providing liquidity and helping discover prices. It's a whole ecosystem. Okay, let's shift gears slightly to the science, or maybe the art, of pricing. How do we figure out what a futures contract should be worth? Given all the different things they trade on, I guess there isn't just one simple formula.
That's right. It's complex because the underlying assets are so diverse. Stocks, bonds, currencies, commodities, weather, they all have different characteristics. But two main theoretical frameworks dominate the discussion: the cost of carry model and the expectations model.
Let's tackle the cost of carry model first. You mentioned it's also called the no arbitrage model. What's the logic there?
The core assumption is that markets are efficient, meaning if there's an obvious risk-free profit opportunity, arbitrage, someone will grab it instantly, and that action itself will eliminate the opportunity. Prices won't stay out of whack for long. So the model says the price of a futures contract should reflect the current spot price of the underlying asset, plus the net cost of carrying that asset from today until the futures contract expires. This carrying cost includes things like financing interest, storage fees, insurance, minus any income the asset generates, like dividends. Essentially, it should cost the same whether you buy the asset today and hold it, or you just buy the futures contract for delivery later. If there's a difference, arbitrageurs will step in.
So if the actual futures price in the market is different from this calculated fair price, that's the arbitrage trigger.
Exactly. Let's revisit that gold example briefly. Spot gold is $62,130. Let's say the net cost to finance and store it for 3 months is Rs 100. The theoretical fair futures price is $62,130 plus 100 R plus R is $62,230. Now, if the actual 3-month futures contract is trading higher, say at Rs 62,280, that's the signal for cash and carry arbitrage. Buy spot gold at $62,130, sell the future at $62,280. This buying pressure pushes the spot price up, and selling pressure pushes the futures price down until they align closer to that fair value plus carrying costs. If the future were trading below the fair price, say at 62,200, it triggers reverse cash and carry arbitrage. Buy the cheap future, sell the spot asset perhaps by borrowing it. This drives the futures price up and the spot price down.
But you mentioned frictions earlier, transaction costs, et cetera. How do they fit into this no arbitrage idea?
Right, those frictions mean the alignment isn't perfect pinpoint accuracy. Think of it as creating no arbitrage bounds or a band around the theoretical fair price. Arbitrage only becomes profitable if the market price moves outside this band by an amount greater than the transaction costs, taxes, margin costs, etc. Inside the band, slight deviations might exist, but they aren't large enough to overcome the cost of trading. So lower transaction costs lead to narrower bounds and more efficient price alignment between spot and futures.
And how does the model adjust if the underlying asset actually paid you something while you hold it, like a stock dividend?
It's straightforward. You just subtract that expected income from the cost of carry. The fair futures price becomes spot price plus financing costs plus storage costs income, like dividends or interest. There are precise mathematical formulas for this using interest rates, dividend yields, and time to expiry, often involving exponents to account for compounding. For example, for an index future, the fair price, F, might be calculated as F, SERQT, where S is spot, R is the risk-free interest rate, Q is the dividend yield, T is time, and E is the base of natural logarithms for continuous compounding. It looks complex, but it's just systematically accounting for all the costs and benefits of holding the asset versus buying the future.
Seems logical. But what are the big assumptions behind this cost of carry model? Does it always hold up?
Good question. It relies on several key assumptions that aren't always true in reality. It assumes the underlying asset is readily available, easy to store, doesn't have weird seasonal supply-demand patterns, and crucially, that you can easily borrow it to sell it short for reverse cash and carry. It also technically assumes no transaction costs, taxes, or margin requirements for the pure theoretical calculation. Because these assumptions often don't hold perfectly, especially for physical commodities, think storing tons of wheat versus holding shares electronically, the model's direct predictive power can be limited for some assets. And importantly, the basic cost of carry model is arguably a better fit for forward contracts because it doesn't explicitly account for the daily cash flow effects of marking-to-market margins in futures, which can subtly change the economics.
That makes sense. Okay, what about this other concept, convenience yield? It sounds less tangible.
It is. Convenience yield is like an invisible benefit, an intangible inflow that someone gets just from having the physical asset on hand right now, especially if it's a commodity that's essential for their business or if there's a perceived risk of shortage. Think about a manufacturer holding inventory of raw materials during uncertain times, like a supply chain disruption. Having those materials physically available provides a convenience, the ability to keep production running smoothly, avoid shutdowns, and meet customer demand. That operational security has real economic value, even if it's hard to quantify precisely. This convenience yield effectively reduces the net cost of carry. Sometimes, if the convenience yield is very high, for example, during a severe shortage, it can actually outweigh the financing and storage costs, causing the futures price to trade below the spot price. This situation is called backwardation. It's mostly seen in consumption commodities, not typically in financial assets like stocks or bonds, where storage is easy and shortage is less common.
Fascinating. So that's the analytical cost of carry approach. What's the other model, the expectations model of futures pricing?
This one is much simpler conceptually. It basically says that the futures price for a certain date reflects the market's collective expectation of what the spot price will be on that future date. It's less about calculating costs and more about gauging market sentiment. If the majority of traders expect the price of oil to be higher in 3 months, the 3-month oil futures price will trade above the current spot price, reflecting that shared expectation.
Okay, so this directly ties into those terms contango and backwardation we hear about.
Exactly. A market is said to be in contango when futures prices for later delivery are higher than the current spot price and generally higher than nearer futures contracts. This often implies the market expects prices to rise over time or reflects the normal cost of carry being positive. A market is in backwardation when futures prices are lower than the current spot price and generally lower than nearer contracts. This suggests the market expects prices to fall, or it could be driven by that high convenience yield we just talked about, making holding the physical asset today more valuable than a promise for future delivery.
So all these mechanisms, cost of carry, expectations, arbitrage, they all feed into how futures help with price discovery, right? Figuring out what something is worth.
Precisely. Futures markets are incredibly powerful price discovery engines. Because all these different participants are constantly trading based on their own information, analysis, costs, and expectations, the resulting futures price becomes a highly visible, constantly updated consensus forecast of where the market thinks the underlying asset's price is headed. And here's the final piece of the puzzle: convergence. As a futures contract gets closer and closer to its expiration date, its price must converge with the spot price of the underlying asset. They have to become identical on the final day. Why? Because on that day, the futures contract effectively becomes the spot asset for settlement purposes. This convergence ensures the futures price ultimately reflects the real-world cash market value at expiry. So if you really connect this to the bigger picture, understanding these pricing models shows that futures aren't just some sideshow casino. They are deeply integrated tools that help discover fair value, allow for efficient risk transfer, and constantly work to align prices across time. They provide a vital, forward-looking perspective on the economy.
Wow, what a journey we've covered today. We started with those basic private handshake deals, forward contracts, understanding their simplicity, but also their big flaws, like being illiquid and carrying that counterparty default risk. Then we saw the evolution to standardized, exchange-traded futures contracts, bringing in the clearinghouse guarantee, margins, daily settlement, all designed to build trust and manage risk much more effectively.
Yeah, and we got into the weeds dissecting the anatomy: contract size, multipliers, expiry cycles, the all-important MTM process. We decoded the jargon too: basis, cost of carry, the difference between open interest showing market depth and volume showing activity.
Then visualizing the payoffs, seeing that linear, potentially unlimited upside and downside, and understanding the roles of the crucial players, the hedgers using futures as insurance, the speculators providing liquidity by taking on risk, and the arbitrageurs keeping prices honest.
And finally, exploring how these prices are actually determined through the logic of cost of carry and the sentiment captured in the expectations model, plus that interesting twist of convenience yield, and seeing how it all leads to price discovery and that essential convergence at expiry.
It really feels like this deep dive gives you a solid shortcut, a way to get quickly up to speed on a complex but really important corner of the financial world. It's about understanding the mechanics behind the headlines. So maybe the next time you hear chatter about market volatility or see reports on oil prices or stock index movements, just take a moment. Consider how these futures markets are working constantly in the background. They're not just passively reflecting expectations about the future. They're actively shaping how businesses and investors manage risk today and plan for tomorrow. And that leaves us with a thought. Knowing how these tools work, what opportunities or perhaps what risks might that awareness open up for you in whatever field or area of interest you follow? Something to think about.